Welcome back to the Canadian Investor Podcast. You're about to watch part 2 of the 32 largest Canadian companies ranking that Dan Kent and I recorded for the Canadian Investor Podcast. Important note, if you haven't seen part 1 yet, that's all right. Pause this video, head over to Stocktrades.ca YouTube channel to catch the first half. For this ranking, we focus on one thing only: business quality. We're ignoring valuation and future potential returns to rank these companies purely on the strength of the underlying business. We're going from S tier, the absolute best, to E tier, the worst, and of course, everywhere in between. Let us know in the comments which picks you agree with and which ones you think we got wrong. Now let's get started. We are back for our part 2 of the 30 largest Canadian public companies. We are ranking them, and as a reminder, we're ranking them by quality here. So even though we may talk about valuations a little bit, we will definitely focus on the quality of the business. So it's very possible that some of the business that we have in the S tier, which would be the top tier, may not be great investment over the next 5 to 10 years. And same could be said from the companies that we actually have in the bottom tiers here. So should be fun to wrap this up. A quick note, we added a couple of honorable mentions. So it's going to be 32 just because there was a few companies, 3 or 4 companies towards the end that were very close in market cap. So we just decided to add them at the end just for the hell of it, just because it was very close. I think in the 45 billion range market cap is where they all bunch in together.
Yeah, and I think they're probably some pretty popular companies as well. So a lot of people might have been asking if they weren't included. But yeah, first half was fun. Obviously S tier, not too many S tiers in the first half, just Shopify, but that should be reserved for the best of the best. But yeah, let's get
started. Yeah, so the first one, Alimentation Couche-Tard. See how I didn't ask you to say that one, just to be nice. This one is a great Quebec story, obviously, but going forward is really where the questions come from for me. Is there going to be growth looking forward? And if so, is there going to be actual same-store sales growth or their merchandise growth? Is that going to grow on a real basis, so inflation adjusted? I'm sure it will grow to some extent, and they've been on a rough couple of years, especially with inflation. We also saw some issues that I think they're panicking a little bit. That's just my perception in terms of growth and how aggressively they went after 7 and 9, the 7-Eleven Japanese parent company, how aggressively they went to that. And honestly, I think for a lot of people thinking they were like looking to overpay for it. And sure, they'll be able to do acquisitions, but they're so big now. And even though it's still fragmented in terms of space, there are some real questions whether growth is going to be really good going forward.
Yeah, I think inflation hit them hard. Also, a lot of people are getting away from pops and chips and hot dogs, stuff like that. And I think at these levels of prices, especially when consumers are struggling, that's why they haven't really done that well, because they make, I think the majority, it's like just over the majority of their revenue comes from fuel, but the higher margin stuff is in the chips and the pop and the hot dogs and stuff like that. I know they're going like the fresh food route, trying to get like healthier options in the gas station, about as healthy as they can get. But yeah, I still think it's a very good company. I think there's a lot of runway for acquisitions just because it's so heavily fragmented, like you said. I would go A tier for Couche-Tard. I don't know about you, though.
Yeah, I think that's fair. I think there would have been an argument to be made in terms of S tier a few years ago.
Yeah.
But now, given, I think, really the growth prospects, there's some, I think, real questions. And I know there's some people that are big fans of this company. And I don't disagree that it's been a great story. But you have to also, when you're an investor, look in the future, right? So what it's been in the past, is it going to be that in the future? And I think A makes a whole lot of sense here. Now let's move on to Canadian National Rail. So the second of the big railways, obviously the 2 big railways that we have here in Canada. Now, Canadian National Rail, great network, but really terrible capital allocation by this management team. It's been really bad ever since Stacey Robinson took over in February of 2022. And of course, they were getting a lot of shareholder pressure to return more money to shareholders in general, which to their defense, they've executed, but the problem is they added about 9-10 billion in debt in that span. Not really much growth to be showed. The stock price is down. They made a bunch of buybacks with that debt, which is never a great idea in my experience. Interest expense has gone up from $6 to about $900 million. Not great as well. So you're looking at much larger debt, more interest expense, buybacks done at a stock price that was more elevated. To me, that's not a great recipe for a railway. I'll let you say what you think about it, but I feel like I probably said it right here.
Yeah, I think it's a weak management team that's protected by a very big moat. Or you could argue like the biggest moat in North America. CP's ate its lunch for the last while here, because CN's added all that debt and really has nothing to show for it. Whereas CP, they've taken on a bit of leverage, but they also have Kansas City Southern. Like they added an entire network. I think with the moat, you almost have to put this one high up, but I'd say management team, I'd probably go B tier. If we're putting CPKC,
no, I think just for the network, the fact that it's the moat is just so massive, and at the end of the day, I may be critical of this management team, but who knows? Maybe they will turn things around, or they'll just bring a new management team. Like they came in after the previous one was a bit of a disaster. So we'll have to see what decision is going to be taken for the next one when they do come. But I think B is definitely reasonable here.
Yeah, I think if you're putting CPKC in A, you got to go CNB because CP has been the better operated railway.
Yeah, exactly. So now moving on here to Manulife. So I think it's the first one of insurers, a group of insurers that we'll have in the back half here. Now, I'm the first one to admit, I think you're in that same boat too. I'm not the most well-versed in insurance companies. That's why I own Berkshire Hathaway, as I would prefer trust a management team that knows the business well than having to learn about it. It's quite complex and not something that interests me or gets me a whole lot excited. I know they've expanded in Asia, however, and they have a large wealth management arm. And there's a lot of Asia exposure, of course, but North America too. EPS seems to be trending in the right direction as well, but it will definitely be dependent on the markets and insurance at their core, an insurance company at their core, but their wealth management is likely going to be fuel for future growth or lack thereof. So that's my quick overview on Manulife here.
Yeah, same with you. Like, I don't really know the life insurers all that well. I owned Manulife a while ago. I will admit I owned it not knowing the complexities of life insurance. I eventually sold it for Intact, which would be a property and casualty insurer. But I do know that Manulife cut the dividend during the financial crisis. And it traded in the doghouse for a very long time until it broke out like a few years ago. But I just don't really know the business all that well. I know it's probably, if you're talking about life insurers, it's probably the best, I would say. Pretty close with something we'll talk about later, like Sun Life, but I don't know. I just don't know the business well enough. I'd probably B tier it.
Yeah, I probably put in B or C just maybe because I just don't know it all that well for C. But yeah, we can do a B, and I'm sure we'll get some comments of people that disagree, but that's okay. We'll go with B here. Now, next on the list, we have Franco-Nevada, the second largest precious metal streamer / royalty play in North America after Wheaton that we talked earlier or in the first episode. They have a cost per GEO of $340. If you remember, you had Wheaton that was a cost per GEO a bit more around, if I remember correctly, $500 in that range. So 532, just had to look at it just now. So clearly lower, but they do have more royalty plays versus streaming plays. So royalty would be oftentimes just off of the revenue produced by a certain mine that they provided usually some financing for. Whereas the streaming play, it's you get a certain percentage of the production at a pre-established cost per ounce. But nonetheless, it's a fantastic business model. I think I said it in the first episode. Maybe I didn't, but well, first of all, I do own Franco-Nevada, full disclosure here, but it is something I'd be thinking about at just doing a equally weighted Franco-Nevada and Wheaton. That's how I think how good these two companies are. They also have no debt and a net cash position. The valuation, of course, is never cheap. I know we're not talking about that, but in terms of business model, I think it's second to none if you're looking for precious metal exposure.
Yeah, I think if you look to like gold from, it was probably like 2011 leading up till the pandemic, like gold went through a big bear run. And I think Franco ended up returning like nearly 300% over that time frame. Whereas a company like Barrick, we talked about in the previous episode, it actually ended up losing 40% over like that 10 plus year timeline. If you think about it, if you have Franco relies on the price of gold and other precious metals, no doubt. But when you have a 10-year dead market when it comes to gold, and Franco can still go 300 plus percent, or pretty close to that. Like that, those are ballpark numbers. It was pretty close to that. I think you have an outstanding business. The elephant in the room, I guess, here would be the Cobre Panama operation. Yeah. That kind of highlights some issues with the business, but that just so happened to be like its biggest exposure. They shut that mine down and it ended up impacting it 20%, I think, to its EBITDA. It could start up again. Right now, we're not 100% sure, but I would S tier Franco. Like, I think when you have a business that can absolutely crush it when gold is in the gutter for a decade, I don't know how you don't S tier that business.
Yeah, I agree with that. It's a great business model if you're looking for precious metal exposure, and you also own it. Full disclosure, we're both owners here. It goes into the S tier. Then again, it's still going to be price sensitive to the price of gold and precious metals in general. And the Cobre Panama, I think it highlights some of the risk, but also some of the benefits of owning a streaming play, because despite that being about 20%, I think, of the output that came to Franco-Nevada, yes, it was rough for six months to a year, but now the market started pricing that in, the fact that it would likely be a full write-off. Now we're actually seeing some better news that they may actually reopen in the next couple of years. It's not a super high probability, but the government of Panama has been much more open about it. Public sentiment has shifted there in that country. So it just goes to show how important diversification is in the mining space. And with the miners, you can only get so much diversification because there's so much overhead cost to operating these mines. But with these streamers, oftentimes they have hundreds of bets, right?
Yeah.
Some will work, some won't work, but it gives them more diversification. And I think that's why it's such an attractive business model. And for those looking at mining companies, we've said it already, but you have to make sure you're aware of the political risk too, because that's a prime example, the Cobre Panama. Now, moving on to the next name here, so TC Energy. Do you want to go over that one? Because this is one I'm not as familiar with.
Yeah, so TC, they used to be they're a pipeline company, obviously, but they spun off Southbow. That would have been a few years ago now, which was their oil and gas pipeline, Keystone, I believe. And that kind of turned the company like TC Energy into a natural gas utility and power business effectively. So it doesn't have any more exposure to crude. Debt is high, like very high, much like Enbridge, but earnings quality probably much higher than they were a few years ago. And these pipelines they're toll operators effectively, especially a lot of them have contracts where they get paid regardless of how much commodity actually gets shipped through the pipelines. I'd probably go in the same tier as Enbridge just because the business model is great. The moat is huge. Obviously, the infrastructure is very hard to replicate, but they just don't really grow all that fast.
So they're probably B tier for TC.
Yeah. Just like a kind of a high yielding, low growth bond proxy almost, I guess you could say.
Mm-hmm. No, that's good. So I don't have too much to add, so we'll just move on here to Fairfax Financial. Again, not one that I know extremely well, but definitely better than TC Energy. Fairfax has done really well over the last 5 years. It's a model similar to what Berkshire does in terms of having a large insurance business and investing the float. So essentially the premiums that they collect, they'll be investing part of that for longer term returns. They've made different bets than Buffett, definitely more on the value side, or deep value side has been a bit more the trend here. Fairfax, I think, did pretty well in the aftermath of the financial crisis. I think they navigated that pretty well. But afterwards, when the stock markets were doing quite well in the 2010s, I think some of the bets they didn't pan out as well. And I think they're not as along the market or bullish as Buffett and Berkshire would be. They tend to hedge a little more, which can be good when there's some big corrections, but obviously when there isn't, it can impact you a bit more. And of course, they've been betting with their CEO Prem Watts, they've been betting more on India, which could be a big tailwind for their business going forward too.
Yeah, I've always chose Berkshire over Fairfax primarily because Fairfax always goes that, I don't want to say like pure speculative, but more like turnaround slash speculative front. BlackBerry would be one of the companies that they invested in based on the turnaround. Toys R Us, they ended up, like, Toys R Us in the US went bankrupt and they ended up buying a bunch of their assets in Canada and betting on a turnaround. They did end up making a bunch of money there, but it's the way they go for a lot of their bets. And also, you'll never see Berkshire taking these big macro bets, but Fairfax did. I can't remember what they did at the end of the financial crisis. They might have made a bunch of currency bets. I can't remember, but it ended up resulting in a long amount of underperformance. And I do believe that he speaks on it and like they regret doing what they did. I think they've calmed down in that regard over the last while. The insurance side of the business has absolutely crushed it. It's been outstanding the last 3-4 years, but I would probably A tier Fairfax. I don't know. It's tough. They do have key person risk as well.
Yeah, they do as well. I think me, it's A or B. I think Prem he's not young anymore. How old is he?
No. And I think there's a lot of issues in regards to
75.
Potentially. Yeah. And I don't know if it's a situation like Berkshire where, they have people in place. Like I think Fairfax family.
Have they groomed? Yeah.
Yeah.
Let's put it B because of that is we're not familiar with maybe if he was in his mid-50s, it'd be an A, but as you get older, you have less life expectancy, although Berkshire and Buffett has proven the average wrong on that. So hopefully it's the same for Prem Watsa, but let's just put it a B for now. Now, next on the list, Suncor. This is a company that I know has hurt a lot of investors in the last 10 years or so. They tend to be seen as the second fiddle to Canadian Natural Resources. But the reality is the new CEO that's been there for a couple of years now, Rich Kruger, has been doing things the right way, I think. So he's been pushing for a lower break-even cost. He's been pushing for better security and better safety as well, and pushing for costs to constantly be lower. And it's really hard to hate that as an investor. They're looking to get it in the mid $40s per barrel in terms of break even. I'm not sure exactly where they're at right now. Maybe they're like mid to high 40s, low 50s at this point, but he's been really pushing on that. That's what you want to see. And as a bonus, you get with them an integrated play. So you own refineries and also retail through their Petro-Canada distributor. There's, I think, a lot of things still for Suncor. You can probably get it a bit more at a discount versus Canadian Natural Resources. So definitely an interesting play. What do you have to say about that?
Yeah, all I'll say is when I worked up north there, Suncor was like the pretty much the way you don't run an oil company.
Yeah.
Constant.
But that was 10 years ago, to be
That
fair?
was a long time ago. Yeah. That was when I would have been like on the tools, which would have been probably like 2016, 2017. Okay. Lots of outages, like lots of safety issues. It looks like they've turned it around, but bad timing on buybacks back during COVID, dividend cut. They ended up having to cut the dividend. The company really wasn't operated that well for years, but I haven't really paid a lot of attention to them, but I'll believe you when I say the new CEO is kind of turning things around. But I'll let you tier this one because I don't really know them all that well.
I like the diversification. Obviously, it doesn't have the same track record as Canadian Natural Resources that we have in the B tier. So I have trouble putting in the B tier. Yeah. I think I'll put it in the C tier, but recognizing that as an investment, it may actually do better than Canadian Natural Resources. But the track record, I think, is what affects it here. And I don't know if I said enough for this episode, Canadian Natural Resources, I do have in my portfolio. Now, next one here. Okay, we had a little guest appearance from my daughter here. That's okay. We'll keep that in. That's funny. So the next one on the list, Loblaws. So the largest, it's really it is the largest grocer in Canada.
Yeah.
I mean, they keep delivering. You could have done a lot worse than owning Loblaws over the last 5 to 10 years. They've really done well. It's not going to be the most exciting business, but really what they've done with their in-store brand, you see it, and I'm sure people listening do shop at Loblaws or Great Canadian Superstore, one of their brands, especially the discount ones. I go back to the chips, but now you're buying stuff for the holidays, and I've seen Lay's chip versus their store brands, whether it's the no name or they have some of the PC, and it's oftentimes like half the price of the brand names, and they taste just as good. So personally, I would never buy the brand name. I'm always going to go to that, and clearly it's good for their business.
Yeah, they have a lot of like discount presence, probably the largest discount presence. And I think like they're a slow growing grocery company, but it's similar to Dollarama. They had a ton of growth pulled forward because when you get 9% inflation, you're going to get a lot of people that are looking for cheaper groceries. I think they're probably one of the best management teams in the country in terms of like capital deployment. They've doubled their operating margins over the last 5 years, I think it is, which is very difficult for a company like this. And they've done that by just reinvesting cash flow to make their stores more efficient, whether it be even something as simple as improving like the refrigeration capacity or efficiency of the stores. Like you would think that would be a minor issue, but every single improvement there goes to the bottom line. Buybacks, they've spent billions of dollars on share buybacks at prices that are like a quarter of what the share price is today. I think it's the best grocer in the country. I probably wouldn't S tier it just because the margins you're looking at bottom line profit margins of 3%.
I think it's an A tier more as well. In terms, it's just because your upside is capped a little bit, right? Like you're buying a Loblaws because you appreciate the steadiness of the business that'll perform well regardless of an environment. If I look at Shopify and Franco that we have up there, it might be less steady, but in terms of potential upside, it's way greater. Of course, with upside says more downside to where you get protected with Loblaws. I agree, A tier as well. Now, the last large bank here on the slate, so National Bank, you want to go over this one and I can chime in afterwards.
Yeah, so I would say they're up there with Royal in terms of being managed so well. They made a few acquisitions over the last while. Canadian Western obviously gets them out of Quebec because National Bank is, if you look to a lot of the Canadian banks, their loan portfolios will look like it'll be a huge chunk to Ontario and then the rest of the country, whereas National is a huge chunk to Quebec and then the rest of the country. So Canadian Western kind of gets them out of Quebec, and then just now they bought Laurentian's retail assets. I think it's still set for approval, but it's probably going to go through. They're probably one of the best in terms of return on equity, in terms of earnings growth, in terms of dividend growth. I would probably A tier them. They're up there with Royal. They have more risk, I guess you could say, because they're a bit more concentrated, but they've handled it very well over the last while.
Probably more room to grow, though, than a Royal. I would
much
say,
more.
I
Yeah,
would argue.
yeah.
So maybe, and I don't have too much to add. Clearly, though, with the Laurentian acquisition, provided that gets approved, that's going to give them even more exposure to Quebec. So not that it offsets the Canadian Western Bank acquisition, but it's funny that it just gives them more assets in Quebec. I have to think that obviously all the big banks are also present in Quebec, but National Bank and Caisse Populaire, I would think now are the two largest players. And for those not familiar, Caisse Populaire is a credit union that's it's very big in Quebec. I think it would be probably the seventh largest or right up there in terms of assets. Obviously it's a private company. It's not publicly listed, but it's quite large. It's not your typical credit union.
Yeah. They've killed it. I like them. I do own National. I own National and Royal. Those are the two banks I own.
Okay, so now let's continue here. So we'll move on to Imperial Oil. Again, one that I'm not as familiar, so I'll let you lead the way for this one.
Yeah, Imperial Oil struggled for a while again, but now they're doing very well. This is actually when I did work in the oil sands. This is actually who I worked for. The buybacks are pretty crazy from this one. They bought back over 33% of shares outstanding since 2021. They've erased almost pretty much a third of the shares. And I think it's a lot of these oil producers really have no future prospects to invest in. This isn't like the oil heyday we seen like post-financial crisis where, all those plants in northern Alberta were going up at an insane pace and it was booming here for sure. I think it's going to be more of that free cash flow return policy. They're going to return a ton of money to shareholders through buybacks and dividends. And I'd probably put this one, it's tough. It's between B and C for me.
Let's put it in C just because we're running out of space for B's.
Yeah, I think I don't know if it's as good as a producer as Canadian National, but
Okay.
yeah, it's close. We're putting it in C, but it's very
Could
close to
be,
B.
yeah, between B and
Yeah.
C. So
Yeah.
let's put it in those. Now the next one, Waste Connection. I know it's a company that you own. I don't own myself, but definitely a very interesting play. Again, I would put it in a similar category to Loblaws in terms of a company that should do well regardless of the environment. Also, a company that may not have a super high ceiling, but again, steady as she goes. And very possible that you look back in 5 to 10 years and you can see that it either matched the markets or slightly outperformed the market. I think these are the kind of companies the kind of returns that you tend to expect for these companies.
Yeah, I mean, I think it's up 1,100% over the last 10 years. It's
Better
been,
than
yeah, it's absolutely crushed it over the last while. They, obviously, with these waste disposal companies, it's like Loblaw in regards to there's going to be activity regardless of the economy, but it is just a much higher margin profile than something like Loblaw. I think operating margins are close to 20%. Pricing power, kind of unmatched. Acquisition strategy. They pretty much put like smaller haulers in a position where they, I don't want to say they have to sell, but they own the landfills. So they charge these small haul companies like a ton of money to use the landfills. And then eventually they just buy them so that they don't have to charge those tolls to use the landfills. The landfills are assets that just can't be replicated, make them a ton of money. A lot of this stuff is inflation linked. Even if inflation gets to 9% again, like if you look to their pricing during COVID, they just effectively offset inflation and then some. I would obviously this is a bit biased, but I would put Waste Connections S tier.
I know where you're going.
Yeah.
Yeah, it is a good business model. It's hard for me to disagree. There is some competition, I think, when you start looking at obviously Waste Management in the US, who also has operations in Canada. Yeah, I think I can give it to you. I can put it in the S tier.
The only difference between Waste Management and Waste Connections is Waste Management is more urban, whereas Waste Connections is really rural. They like smaller haulers that they're more small ball acquisition, whereas Waste Management makes big plays. Yeah. So they are competition, but in terms of acquisitions, they don't really conflict all that much. There's plenty of room for both of them. I think they do both of them. I think Waste Management's 20% of the market. And I think Waste Connections is like 6%.
Okay.
Yeah.
Okay. So we'll put it in S tier. Yeah. Feel free to disagree in the comments here below. Yeah. Now, next on the list, Great-West Life. Similar to Manulife, but Great-West Life gives you more exposure to the U.S. with Empower. They'll be dependent on that HO asset under management as well. But again, insurance is their core business here. So probably a bit safer than Manulife because of not having that Asian exposure, but maybe a bit less in terms of potential growth. And so that's the overview. Anything to add here for Great-West Life?
No, again, I don't really know life insurers all that. The one thing I will say is like for the better part of 15 years, these stocks pretty much traded in tandem, like share price wise, until 2024, and then Manulife just took off.
Well, Great-West Life did pretty well too, I think.
Oh yeah, they've both done very well. Yeah. I think they're like 250% over the last 10 years. Like they're good companies. Mm-hmm. I just don't know them all that well, so I'd probably B tier it.
Yeah, same exactly. So just looking at Great-West Life, last 5 years, 131%. Yeah. So it's done pretty well. Yeah, I'll put it B because I don't know enough to favor one over the next. Yeah, I'll go with Great-West Life here. Okay, now next on the list, so a pretty well-known company. I think anyone listening to this will know this one. So it's Dollarama. Dollarama, which has done extremely well, especially I would say pretty much the last, 10 years, but it did very well during the pandemic where people were looking for ways to offset inflation. And they were able to still increase their prices, but still offer enough value for people to choose to go to Dollarama. And it feels if you can't get to a Costco or you don't buy large quantities enough, you end up going to Dollarama. It's the sense that I get, but they also have Latin operations that are doing quite well. So really impressive company. Every time I think it is going to slow down, it still keeps delivering.
Yeah, it's was the play like Dollarama and Loblaw, I felt were the play on people looking to save money because costs have gotten so high. Yeah, they have like Latin American exposure. What's it called? Party City? Or no, sorry, Dollar City. And
Dollar
then they
City, yeah.
have
Which is
Australia. They
big in
bought,
Colombia,
yeah,
which also has, I think they're opening some in Mexico, if I remember
they
correctly.
started a pilot. I think they
Yeah.
have 9 stores open in Mexico, and then they bought the Reject Shop, which is a dollar store in Australia. And they're right now they're revamping a lot of them, turning them into Dollaramas. Because a lot of the time, if you look at a company like Dollarama, they have 25% operating margins, which is crazy. There's not another dollar store that even comes close to that. If you look to what's the one in the States? I can't remember. Dollar Tree.
Dollar Tree, yeah.
Yeah,
There's
like they,
Dollar Tree, Dollar General, Five Below. There's a few
yeah.
different ones, yeah.
But Dollar Tree, I think Dollarama like triples the operating margins of Dollar Tree. So like in theory, they're going to buy the Reject Shop in Australia. They're going to revamp them to Dollarama, which will improve the margin profile, things like that. And I think the company has a ton of runway because they've killed it just in Canada alone. If they can expand internationally, yeah, it's an amazing
Okay, so
business.
what tier?
What are we going to
What
do?
tier? Yeah,
I mean,
I think at this point I would have struggled doing this, but it's hard to argue with the results. I think I would probably go S tier for them.
I think so, yeah. Because if you think about it, if Loblaws is A, and you have Dollarama, which is similar exposure
Yeah.
with 5 times the operating margins, I think S is pretty appropriate.
The only thing with Dollarama going forward is I know a lot of their stuff comes from China. So
Yeah.
if Canada starts imposing tariffs on China a bit more aggressively, maybe to appease the US, I would not be surprised to see that in 2026, 2027. I think that's the bigger risk where a Loblaws would not have as much risk to China in terms of exposure. So I think that would probably be the argument to also put it in A, but I'm okay for now until those risks materialize to put it in S. Next on the list, Intact Financial. This one, I think you know a little bit. Do you own it? I can't
Yeah.
remember. Yeah, you
Yeah,
do.
I've owned
Okay.
Intact for, I think I sold Manulife in 2021 and bought Intact. But yeah, they're a property and casualty insurer. They're the largest in North America, I believe. And I think they own
Bel Air
18% of the
Direct.
market.
Yeah.
Bel Air Direct, yeah, BrokerLink, things like that. They only own 18% of the market, but I think they're the largest P&C insurer in North America. Property and casualty is usually more profitable than life insurance, but it's also exposed to like catastrophe losses. There's a lot of that type of stuff, especially there's been a lot more recently, but
Yeah.
they have one of the best combined ratios in the industry, which just quickly combined ratio is effectively the premiums collected versus what they have to pay out. You want to see it below 100%. I think Intact is frequently like low 90s, which is pretty good. I wouldn't S tier them. I'd probably A tier them. They've done very well.
I'm on board with that. Yeah.
They've raised their dividend every year since their IPO back in 2004, like double-digit earnings growth pretty consistently. Yeah, they're pretty solid. They're the only P&C insurer on this list, I think. The rest of them are all life insurers.
Yeah, I think so. I think you're right. Now, Kinross Gold. So the last gold miner here coming in at number 30. And of course, there might be some small discrepancy by the time you hear this in terms of the market cap, but we did our best to put it as closely as possible as the data we had at the time of recording. And we're recording the second one December 22nd. The first one was done about 7 days ago, I think. Kinross Gold here. The reason for me, it would be at the bottom of the list in terms of producers. They have a all-in sustainable cost per ounce of gold of $16.22 in the latest quarter. I believe that's higher than Barrick as well. Nico was much lower, but I think Barrick Gold was also lower than that. So that's clearly something you don't want to see. You want lower is typically better. They have good geographical diversification, which is obviously better than Barrick Gold. So I think that's a plus for them. They have exposure to Brazil, Canada, US, and Africa. But again, there's still some jurisdiction where it can get tricky. And we talked about the Cobre Panama. That's an example of what can happen where there's political risk and you're forced to either close a mine or modify your operations, which gives you a hit to your operating profits and your margins. I'll let you talk a little bit and then we can put it in the ranking.
Yeah, I don't know the company all that well. All-in sustaining costs of $1,600 when you have exposure to places like Africa and Brazil. You look at Agnico, in very stable regions with lower costs. So I'd
Yeah.
probably prefer Agnico. Yeah, I don't know. I'd probably D tier it with Barrick just because of that. Yeah.
Yeah, D or C, I think it's around there. Barrick, I guess the all-in sustainable cost is lower, so that's a plus, but they have more risk, I think, from a
Yeah.
political risk. So maybe, yeah, I think D is probably right. Of course, right now, all three of these companies are printing money. When you have
Yeah.
the price of gold, which is looking at today, it's ripping again. So it seems like it wants to hit 4,500 by the end of the year or something. It's 44.33, so 4,433 in USD. So clearly, they're making a whole lot of money right now, but you want to also look in the future if there's a pullback in the price of gold, or their costs, inflation starts picking up, the prices of oil starts picking up, their costs would also starts picking up. Even if the price of gold stays elevated, if their cost keeps going up, then of course that will eat in the margin. So something to keep in mind. But I think D is good here. Now, next on the list, Sun Life Financial. Is your knowledge the same as Manulife and Great-West Life, or you know a bit more about this one?
I know Sun Life has a lot of exposure to the United States, I think. I can't remember. There was something that happened in their business last year, I think, that ended up their US segment took a bit of a hit. I don't know if it was healthcare. I was trying to look it up, but they've really struggled over the last bit just because of those US issues. I think US earnings declined like 40% or something like that. But outside of that, yeah, it'd be much the same as me. Like I don't really know the business all that well to make any determination. The one thing I do know is Manulife and Great West are really not struggling at all anywhere, whereas Sun Life is in the US. So for that reason, we could maybe C tier it.
Sure. We can put in C tier again. We don't know these businesses very well, so keep that in mind.
Go easy on us.
Feel free to disagree with us. That's completely fine. Now, the next one on the list that if we had done this a year ago, definitely would not have been on this list. Celestica. You want to go over a little bit here? I know it has like networking switches. It's benefited a lot by the server build out for AI. This company has just been on a tear this year, but I think for the better part of a year and a half, 2 years now.
Yeah, I think back in, it might have been 2022, this would have been a small cap stock. Now it's on the 32 biggest TSX stocks. It's pretty crazy. But yeah, networking switching, they kind of design and manufacture a lot of stuff that goes into data centers effectively. Like you can think of something like GPU racks and things like that. And I think this was like a very mediocre operated business for a very long time. And then AI just fell into its lap. Obviously, you can see if you look at their long-term returns, it was pretty much dead money for, I think it was close to 15 years or something like that. I think it returned 2% annually leading up until the big AI boom. I know,
but in the last 5 years, it's up 4,062%. Or
that's what I mean. It just you can't. I don't know if you could think of a single company that benefited more from the demand for products inside data centers. It was absolutely crazy. If we think of like where to tier it, it's difficult because is it a strong business? Yes, if AI spending ramps back up, like.
Yeah, and I know they can do some custom stuff too, right? I don't know the business very well, but as I would,
they design, so like you can have it creates a bit of sticky revenue because say you work with a company like Alphabet and you design a system for them. If Alphabet ever wants to get more of them or make modifications, they're going back to Celestica, and I don't know. It's difficult for me because if data center spending slows or if supply catches up with demand. And we see
it can be very cyclical. Let's just say that. And there could also be some other players. Whenever you see some like a company crushing it for whatever reason, it does encourage competition.
Yeah.
So I'd be fine with a B without knowing the business, to just acknowledging some of the risk associated with the growth.
Yep. Yeah. And like you do say it's cyclical, which it is. And it's just very difficult to know how cyclical it is because we don't really know, how long this build out is going to last. But the one thing I will say is, if data center spending slows down, they will be hit. They will be hit pretty hard.
Okay, I think that wraps it up. So I will share here the present, doing the slideshow mode so people can actually see the full screen. So in the S tier, as a wrap up, we have Shopify, Franco-Nevada, Waste Connection, Dollarama. A tier, we have RBC, Brookfield, Thomson Reuters, Wheaton, Constellation, CPKC, Alimentation Couche-Tard, Loblaws, National Bank, Intact, and then B, we have Enbridge, BMO, Agnico Eagle, Canadian Natural Resources, Canadian National Rail, Manulife, TC Energy, Fairfax, Great West Life, Celestica. C, we have Scotiabank, Suncor, Imperial Oil, Sun Life, and D, we have Barrick, CIBC, TD, and Kinross Gold. No companies in the E tier, which is not surprising. If you get that large, you probably have a decent business model to begin with. That's usually where I come from. If you get into the 40 plus billion market cap, usually there's the reason for that, unless it's pure speculation like some of the meme stocks. But I don't think we're talking any meme stocks in all of these.
No, I guess the one thing we'll say, and we were discussing this before, is you'll notice one specific industry that is missing, that all three of them would have been on this list even 5 years ago, and that's the telecoms.
Yeah, that's correct. Yeah, they're all in the, I think, around 15, 20, 25, 30 billion, that range. I looked at it, but yeah, that was one that was surprising. The fact that Rogers, BC, and TELUS, none of them are in this category. Pretty surprising.
Yep. And they've been, I think for the most part, like I was looking up a list, for the most part, they've been replaced by the gold producers.
That's right. Yeah.
It makes complete sense. Like a lot of these gold producers are up 300, 400%, while the telecoms are down 30, 40%.
Yeah, and you have also, I think there was Nutrien that was right on the verge too of making the list. So there's quite a few that were close, but the telcos were, they were not like a few billion off. Like I think they were like in the 5 to 10 billion range off at least. Yeah. So just goes to show how they may have these businesses that, yes, have a whole lot of customers, but when your growth slows, there's clearly less immigration coming into Canada, which, of course, when people come into the country in large numbers, they need a cell phone, they need internet. There's 3 major providers. They're probably going to get the bulk of that. And then when that slows down, it's clearly going to affect the business. And when you don't have a lot of new people coming into the country, then it does increase the competition because they are going aggressively again, like at one and another's business. So you can really leverage. And I did an episode on how you can cut your phone and internet bill back in November for Financial Literacy Month. So you can go back to that episode, but you can really play them against each other and reduce your telephone bill. And you can actually see that when you look at the revenue per user. It has gone down in recent years, I think in big part because of that.
Yep. They thrived a lot on cheap debt, I would say, post-financial crisis.
And quickly, when population grows quickly, obviously it's going to be a big tailwind for them. It's pretty easy. And when you have a large fixed asset, the more subscribers you can get to your services, there's not that much cost that go with adding other subscribers. Once you have them, the assets are there already, right? You've already invested. So clearly for them, it was a big boom, but now also a problem as it's slowing significantly down. I hope that you enjoyed this video where Dan and I ranked the 32 largest companies in Canada. Make sure you leave a comment below. Let us know whether you agreed or not with the rankings that we did. Give us a like. And make sure you subscribe to this channel. We'll be adding some weekly content, not only for the Canadian Investor Podcast, but also the other podcasts on our network, the Canadian Real Estate Investor Podcast, hosted by Dan Foch and Nick Hill.